A dangerous disconnect. Morgan Stanley has issued a strong warning, stating that there is a dangerous disconnect between the U.S. stock market and the underlying economy. While the stock market continues its upward trend, the bank's analysts suggest that economic fundamentals paint a more concerning picture. The market's high valuation is a key concern. The S&P 500's price-to-earnings and CAPE ratios are both significantly above their historical averages. Despite this, the index has gained almost 10% in 2025, with the Nasdaq up over 11% and the Dow advancing more than 7%. The Magnificent Seven versus the rest. This divergence is largely due to extreme market concentration. The Magnificent Seven technology giants now make up nearly 40% of the S&P 500's market capitalization. These mega-cap stocks have been the main drivers of the market's recovery, consistently beating earnings estimates, while the other 493 stocks in the index have struggled to keep pace. According to Morgan Stanley strategist Arianna Salvatore, this is because positive influences like tax reductions are widespread, while negative effects, such as tariffs and immigration policies, are primarily felt in sectors that do not make up a large share of the S&P market cap. The economic reality. While second quarter GDP growth was 3.0%, the report highlights underlying vulnerabilities. For example, residential investment fell sharply, and labor productivity gains were offset by rising unit labor costs. Morgan Stanley projects that unemployment will rise to 4.5% by early 2026, signaling potential fragility in the labor market. The firm also anticipates a period of higher inflation as economic activity slows. Advice for investors. Morgan Stanley warns that markets are pricing in a Federal Reserve rate cut in September, which could create additional uncertainty. The bank's Global Investment Committee recommends that investors diversify beyond U.S. equities, prioritize fixed income assets with yields of 5 to 7%, and rebalance their portfolios towards macro-sensitive sectors like financials and industrials. This advice is in response to a structural mismatch between the Fed's use of backward-looking indicators and the forward-looking nature of the equity markets.